The stock market has been having huge swings up and down. The cryptocurrency market has been beaten hard, and real estate is very expensive. And if you don't have access to at least $100,000 of cash, it's going to be very difficult for you to start investing your money in real estate. So what do you do? So what I want to do today is go over 5.5 different ways for you to invest $5,000 today in this economic environment and actually build some wealth with this $5,000 that you're investing. But before we get into number one, I need you to do me a quick favor and smash the thumbs up button below. I'm going to start by talking about the HAF because there's been a lot of talk about I-bonds and a lot of questions about I-bonds in my comment section. So I want to start by talking about that. An I-bond is a type of treasury bond that gives you a return that's matched to inflation. So a bond is a loan and a treasury bond is a loan that you make the government. So an I-bond is a loan that you can make the government, and the return that you get is going to vary depending on how high inflation is. If inflation goes up, the return on the I-bond will also go up. So it's a variable interest rate, and this interest rate changes twice a year. Between now, the time of me recording this video, and October 2022, the interest rate that these I-bonds are paying is 9.62%. Clearly, that is a high interest rate, which is why so many people have been moving their money to I-bonds. Now, there's a couple caveats here. The first thing that you want to understand is the limit of how much that you can invest, because there is a limit. If you are electronically investing your money into an I-bond, the maximum amount of money that you can invest is $10,000 per year. Now, if you're married, you can do $20,000 per year, but per person, $10,000 per year. The second thing that you want to understand has to do with the term, the time limit, because this isn't something that you can just sell in 6 months. I mean, you could, but there are fees associated with that, because typically an I-bond is something that you buy and hold on to for 30 years. Now, you can sell it earlier. You can cash out whenever you want, but there are penalties if you cash out before 5 years. If you cash out after 5 years, there's no penalties, so technically you can sell it anytime you want after that without worrying about any fees. But if you cash out before you own it for 5 years, then there are penalties that you have to pay to take back some of the interest that they pay you. The third thing that you have to understand is going to be interest rates, because these interest rates that you're getting is not consistent, it's variable, it's going to be changing based off of inflation. And if inflation starts to go down, in theory, your interest rate should also go down. And then the fourth thing is the risk. So I personally am not a huge fan of investing my money in bonds because the returns, especially on treasury bonds, tend to not be very good. Now, the return here is much higher, but then the second risk with treasury bonds is the default risk. Now, traditionally, growing up, I think everybody has heard that bonds are the safest investment, because now you're lending money to the United States government, and the United States government is backed by the full faith and credit of its taxpayers, so you have no risk. But that risk is starting to go up. That's one of the reasons why these I-bonds pay so much more, because there is a risk of higher inflation. Higher inflation means a higher risk of United States government default. Now again, is that risk very high? No. But that risk is there. So it's just something that you want to be aware of, that there are risks associated with these I-bonds, because there's a risk of a potential default. If the government defaults on some of its debts, then you would lose your investment. If this is something that you're interested in, you can go to treasurydirect.gov and buy an I-bond over there. The second way that you can invest $5,000 is by doing something called DCA, or dollar cost averaging your money into the stock market. Because if you have $5,000 and let's say you take $2,500 and you find a good company that you want to own, and then you buy it with $2,500, and then it goes down even further. And now you say, oh, this is an even better buying opportunity. So then you take your last $2,500 and then you invest that into the company, and then it goes down further. Then what? You have no more money to come in and buy, and if you get scared, then you might sell, and now you lose a big chunk of your investment. So instead of just perfectly trying to time the market, which is something that you can do if you're willing to put in the work, but if you don't want to put in all that work, time, effort, and research into investing into individual stocks, the next best thing is to just dollar cost average your money into the stock market. Now, I'm going to be completely honest here. The idea of investing your money in the stock market can be very attractive. It's a hot thing to do, which is why trading is very popular, trading options is very popular, Forex is very popular, because you want to see those quick gains where you want to find a hot company, buy it, and ride it up. But the people that build the real wealth, and I'm talking about real wealth, not just a little bit of money here and there. Real wealth in the stock market are not the traders, it's the people that invest their money over the long term. Now, this type of long-term investing isn't as attractive because it's not as appealing, it's not got that same sex appeal as everything else, but This type of long-term investing is where the real money is built. And if you're trying to do this successfully, instead of trying to perfectly time the market, what you can do is dollar cost average. This is what people hope that a stock chart will look like. They hope that they buy in here and that it's just going to go straight up. But what actually happens in reality is you have a lot of this. Ups and downs in the stock. And the goal is that over the long term, you start to see this upwards trajectory, but it's not going to be straight up like this. You're going to see ups and you're going to see downs. And so what happens is everybody assumes that if I just buy it here, then I can time the bottom and just ride it up. But it's not so easy to do that because nobody knows when the bottom is. You might see it go down here and say, oh, I found the bottom, and then you come in and buy, and then it goes up, and then it goes way lower, and then you panic, and maybe you sell. So there's no way to perfectly predict that, but the next best thing is, instead of trying to perfectly time the market, is you just try to dollar cost average, which means you have a system where now every so often, maybe every week or every 2 weeks or every month, you're just adding more money into the market. This could be into a certain number of ETFs, stocks, whatever it is that you want. You just dollar cost average, where now it's consistently investing your money. That way now you buy some here, 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 you buy some here. And now you're just averaging your cost basis. That way now you're not buying at the peak, you're not buying at the bottom, you're just averaging cost basis, and then you just keep accumulating more shares over time. And then if you see a dip, well, then you can come in and buy even more aggressively, but you're still buying because you have the dollar cost average system set up. I have a dollar cost average system set up where every Wednesday, once a week, I have some money that leaves my checking account and is automatically invested into a handful of ETFs. So if you have $5,000 to invest, instead of trying to take all of that money and just dumping it in today or tomorrow or next week, hoping that you found the perfect time, break it up into pieces, buy in phases. That way now you can buy on the way down. And even if you don't want to create this type of automatic system where it's happening every week and you want to be a little bit more involved, then what you can do is you come up with a list of ETFs or stocks that you want to own. And then anytime you see these ETFs or stocks fall by 10 to 15%, you buy. If it falls by another 10 to 15%, you buy even more aggressively. If it falls by another 10 to 15%, you buy even more aggressively. So now you break up your $5,000 into a few different chunks, and then you buy slowly and you buy it at a good buying price. This way you're not chasing companies, but you're looking for that right opportunity. If you enjoyed this short clip from my longer videos, here's another clip that I think you'll love. And while you're at it, if you're interested in learning more about how to start generating passive income, our team put together an amazing guide that goes over what passive income is, how to start generating passive income, and different passive income strategies. These are things that you can start doing even if you don't have a lot of money. So if you want to read this free guide on how to start generating passive income for free, all you got to do is click that button right over there. Thank you for watching, and as always, keep hustling.